Three, two, one. We are live. Hello and welcome to PropTechBuzz, a business podcast on global PropTech, where we talk to PropTech founders, CEOs, and VCs from all over the globe and learn from them how to build and scale successful PropTech companies. Today we have an exciting guest with us. His name is Julian Brockhurst. He's a VC at Venture Crowd and director at PropTech BNE. I just bumped onto his profile, very fascinated with what he has done over the years, and I thought he would make for an excellent guest with us. We did a deep briefing before we met for preparation, and we were about to have some very deep conversations. I said, "Hey, hold on, let's have these conversations on our live podcast." So we stalled those conversations, and I'm looking forward to have some very deep conversations on everything that he has to share with us today. Before I invite him, I would like all my lovely audience out here, if you have been listening to our content, have yet not subscribed, then please hit that like and subscribe button on YouTube, also on Spotify, on the audio only podcast as well, because the more people like and subscribe, we reach out to a wider audience, and that's the shot in the arm that we want. PropTech is still a niche sector. As a result, we need as much help from you to reach out to wider and wider audience. With that, let's welcome to our guest today. Julian, welcome to PropTechBuzz. How are you doing today?
Very well, Ravi. Thank you for having me.
Julian, before we set the context on the venture side of business and set the context of how things are, what would be good for the audience to know is a little bit about your personal background. What all have you done in your career, and then we move on to the meatier stuff that we have for today.
Yeah, absolutely. I mean, I think like everyone's journey, one is somewhat unique, and I've been fortunate enough to sit on seemingly all aspects of what the PropTech ecosystem really has to offer, be it on the association side, be it on the startup side, ventures side, and in the sort of the property industry itself, or the industry players. And so while dabbling in all those bits, it's been great to sort of try and understand how they all work together, which is obviously the discussion we'll get into today. But I mean, my background, Ravi, if we want to go back to the earliest beginnings, I'd studied property finance and always sort of had the property industry on my mind. And I guess throughout my career, as I've started building, I thought it'd be more the traditional, the property finance aspect, essentially working at a bank, lending out construction loans or, mezzanine financing to developers. But certainly, as an 18-year-old entering university was where I thought I'd end up. I then ended up at a startup in Europe. And that was in the e-travel space, which was very different to the property space. But it was an incredible experience in terms of scaling a business, working with the likes of hotels.com and Kayak at the time. It was a really interesting time back in sort of 2013 when, cheap airlines really started to take market share, when Facebook ads and you could reach your customers in a very cost-effective way. And we were sort of targeting the sort of, 25 to 35-year-old. And so learn a lot about digital marketing, digital advertising, go-to-market channels. I was then given the opportunity to join a team based in New York, working for a company called ServCorp. ServCorp and for that matter, Regus, I'm sure Regus, especially in Europe, will ring a bell. Co-working, flexible office space. The concept wasn't new. It had been around for sort of 30 years back in the 70s when those two businesses, ServCorp based in Australia, Regus in Europe, started. But in 2017, I was given the opportunity to move to New York, and that was to really try and aid the ServCorp American business, because as we all know, 2017 and probably a bit earlier was sort of the rise of WeWork. And for no matter, the feeling of what WeWork is today, at the time it was a behemoth. It had a war chest from SoftBank. And what it did really well was educate the entire market on what flexible office space was in a way that ServCorp and Regus had not been able to do. But obviously then, we were sort of eating into market share. So that was a really interesting space, sitting on sort of I guess, industry side and working in commercial real estate in New York. And then after 2 years, the visa ran out. And I guess when I moved back to Australia, I reflected on what I'd sort of wanted to do when I got back to Australia. And during the time in New York was when I was, I guess, exposed to property technology. WeWork said it was a PropTech business. And what is property technology? And that's when I got engaged with the likes of Metaprop, showed up to a few of their pitch events. AWS put on a lot of events. New York is a very big hub for innovation and investment at large, and certainly had a growing ecosystem in the PropTech space. So when I moved back to Australia, I knew I wanted to focus on that, and I ended up being offered the opportunity to join Second Century Ventures and their Reach program, which at the time had just been US based. And so they were finding a lot of companies coming to the US to sort of, I guess, learn the lessons and gain the expertise in what it took to scale businesses. But a lot of these businesses were coming from Asia, were coming from Europe. And I guess the idea was that instead of the businesses coming to us, we'll go to them and we'll set up some outposts in some of the bigger regions of the world. And so they decided on Australia as the outpost in Southeast Asia. And I worked to sort of build up that fund and that accelerator and launch it. And we unfortunately launched the day before March 19, 2020. And March 20th, 2020 was when Australia shut down from the COVID pandemic. And so all of our planning over the past sort of several months, all of our, sort of events that we'd scheduled, flights that were booked, had to be cancelled and completely ripped up and pivot the entire program and the investment thesis over a matter of weeks, which was a really interesting time, I'm sure, for everybody on the call. And so while working with them, that started my ventures journey, that in pure on the investment side of the business. And then beyond that, I've started working at a firm called Venture Crowd. And while it's quite agnostic in terms of its sectors that it invests in, I certainly fly the PropTech flag internally and have continued that journey. And now actually find myself in Stockholm, Sweden, based in Stockholm, Sweden, and really looking to engage and elevate the PropTech ecosystem from the experience gained from Australia, and sort of take that next step.
Excellent. Thank you so much for taking us through your very, very fascinating journey, and lots of venture experience. And that's exactly why I wanted to talk to you. So venture, as we know, is same as any other business. They have investors and business plan, right? So what are your thoughts around say running ventures and running businesses? What's the difference there?
Yeah, as you say, Ravi, the venture business itself is sometimes, certainly from a startup perspective, misunderstood, and therefore it's always really good to understand what a venture fund is as a business, what motivates it, how it monetizes itself, and then how it looks to work with startups. So ventures itself, many startups find themselves in the same position of wanting to raise capital. In the same way you look to raise from investors, so do venture capital firms. They look to build a fund, raise from investors, and then deploy that based on a mandate that they have created and that they promise to sort of stick to. And that's why they think they can get outsized returns. And so they really, when they are looking at building out, their first fund, their third fund, their eighth fund, whatever it may be, they're sort of building on the experience that they have in the ventures, on the ventures side, building on the sort of, I guess, the returns and their brand as they look to, attract a better pipeline, better companies, better founders. But at the end of the day, it is a business. And I think it's not a charity. It's free money. It is a business, and it is trying to derive a return from the capital invested. And it's important to keep that in mind as on the startup side, when you are engaging with venture capitalists and investors, in understanding what motivates them, just as much as they're trying to understand what motivates you and what's going to make you the best person to solve that problem that's going to create a very lucrative business over the sort of medium term. I think obviously in the current environment, the current sort of global macro environment, with some sort of headwinds on the interest side. Coming out of the pandemic, got the war still there, energy prices, global supply chains. All of these things affect venture firms in much the same way, but when they are looking to raise capital. So yeah, I think that again, we can get into maybe, if you want to, the more specifics around the ventures
Yeah.
business. But as it from a high level,
Yeah.
that is what it is. They raise capital, they build a fund, they deploy it, and they have a certain timeline in which they are to return that capital to their investors.
Right.
And the startups themselves are sort of married to that timeline, if it were, and their mandate, and that's what's going to motivate them for the duration of that relationship.
Got it. So let's get into specifics here. Okay. I haven't gotten into specifics. My past VCs that I've spoken to were from PropTech space, and they were primarily talking about their portfolio. But let's understand a bit about deployment, right? You first of all, you find usually VCs. What is the kind of sources of funds that they look for when they're running a VC firm? Okay, is there a specific VC that is tied to their LPs, or they are open to more LPs? Can they broaden their LP network? How does that work out? And where do they keep looking for newer sources of capital to keep deploying?
Yeah, I mean, it really depends on the firm, right? And the fund size that you're going after. And obviously, smaller funds can go to smaller LPs and vice versa. The sort of the blue chip LPs are sort of the big institutions, the big insurance companies, the big endowment funds, in Australia, superannuation and retirement funds. They have a lot of capital and they have a long time horizon on that sort of capital and that return. Thinking about the way that those big institutions deploy their capital, they also have a mix, of which venture is a small portion, right? Venture capital will be an allocation, 5 to probably 15% in some cases, certainly recently, of that big pool of capital that they are managing. And so that is where PropTech funds or venture capitalists, the same way that startups compete for capital from venture capitalists, venture capital firms compete for capital from institutions.
Right.
And so that is where they're looking for, the blue chip investors. You also have governments, you have high net worth individuals, you have other investment firms, fund of funds. I mean, the sources of capital is somewhat limitless in terms of where you go looking for that. And so they'll be looking for, PropTech specifically will be looking for regions of the world that have a mandate to deliver some sort of built environment outcome. And so, if you think of sort of at the moment, I guess there's you'll probably see a lot of venture capitalist firms in the Middle East, as they transition away from sort of being a very much oil-based economy, and how they're going to sort of transition out of that, whether that's through climate tech, which again, I know we're going to get into about climate tech first, prop tech, but they'll go to those regions of the world where there are some very, very deep-pocketed investors. You look at Australia and Southeast Queensland specifically with the Olympics in 2032. So obviously there's going to be a lot of government support there around new innovation. You're looking at the different government policies in Europe and America specifically. Again, more around climate tech, but a lot of prop tech these days has a climate outcome. So that's where they're going to be looking for support. High net worth individuals, family offices, of course. But again, that gets nuanced. Again, in so many ways, venture capital and their relationship with their investors is relationship-based, just the way that in venture capitalists and startups is very much relationship-based, certainly at the beginning. And so, the path that, whether you're a startup founder on this, that you feel like you're taking, and that it's hard to get capital, it's hard to do your pitch several times a day to several different investors. VC firms, when they're in fundraising mode, are doing the exact same thing. And I think that sort of gives them a little bit of empathy for when founders are going through the process, because they understand what it's like. It's obviously slight nuances, but they're raising capital in much the same way.
Got it. You mentioned about their appetite for the horizons in that they want to stay invested. Is there any standard there? Like, what is like? Are there some LPs who look to be invested, say, on 5-year horizon or a 10-year horizon? Is there a standard there?
I think there's a standard on mandate or sort of a range in terms of what the VC firms are saying when they'll start to return capital and close the fund and move on to the next. So, a mandate, just like anything else, will sort of outline their investment thesis, the regions or the companies or the business models that they're looking to invest in, the time horizons of that, and therefore investors can choose to opt in. And from a time horizon perspective, certainly it's that sort of 7 to 10 year fund cycle that we so often hear about. Importantly, though, that is a fund cycle. That's not necessarily a deployment cycle. And the difference there is that VC firms will, once they've closed a fund, will look to deploy that capital over maybe a 3-year period. We've obviously seen that deployment cycle shorten throughout the craziness of 2021, 2022. Where some companies were deploying all of their capital in 12 months. And once they've deployed capital, it's sort of like planting the seeds. You need to go find some more seeds, some more capital to then invest. They'll be looking to raise a new fund. I think we're seeing now the data sort of showing that those deployment cycles are starting to expand again and sort of maybe come back to that sort of 3-4 year horizon. But once the capital is deployed, there's always some in reserve to support the winners within your portfolio, right. And then let those mature and potentially come to a liquidity event in that sort of 7 to 10 year horizon. There's probably a little bit of a friction point, certainly in the PropTech space, with the funding cycle of 7 to 10 years and the realities of scaling a PropTech business, and especially on the hardware side. At the end of the day, property is tangible. Property is it's got, I guess, atoms, right? To borrow sort of the analogy from Brendan Wallace, atoms versus bits. It's harder and it takes longer to scale a hardware business. So the reality of those exits or that sort of getting to a critical size is probably going to take 10 years plus. And so I think we'll see the venture firms that are specifically aimed at, again, climate and PropTech probably start to extend those horizons, and what they're sort of communicating with their LPs. But yeah, I think at the end of the day, it really comes down to individual firms. Just like there's a multitude of different startups, there's a multitude of different firms with different theses and mandates and time horizons and targeted IRR and all that sort of stuff. So I think as a broad scale and more just to keep it at a bit higher level, I know we want to get into the detail, that it is traditionally a 7 to 10 year fund with a deployment cycle around that 3 years, and you sort of just lay that as a normal fund structure that'll serve you pretty well.
So I'm very, very curious to know about the philosophy of these LPs, high net worth individuals, because usually are they driven by a certain philosophy of bringing impact and change to the world, or primarily the motivation is returns? Okay. If that is the case, then only the software SaaS businesses will be invested in. There are some hard problems to be solved, which obviously will not give you returns in the short term, right? So are they driven by a certain philosophy of the greater good, or primarily their interest is which are the investments that are going to give us the biggest bang for the buck?
If we think about it as a sliding scale, I'd say that maybe it probably initially started as purely a financial outcome, right? We want to invest in a venture firm that's going to get a good financial outcome. Certainly, again, when the environment and climate wasn't part of the conversation in the 70s and 80s and 90s. As that's become more of the conversation, and as that's become more of an outcome, a desired outcome, there's certainly, I guess, support for funds that are driving a climate, an ESG, an impact outcome. And so we'll see the LPs sort of looking for funds and filtering funds, much the same way that anyone will filter a startup based on what their mandate is. That is sort of coming up that sliding scale between sort of pure financial outcome and pure climate outcome, which I don't think is mutually exclusive. But certainly in the past, there's the thought has been that to get a better financial outcome, you have to, I guess, give up a bit of a climate outcome. I think those two are really coming to a point now where you can get great returns, outsized returns, market-leading returns by still having that a strong climate impact mandate. And it's based on policy, right? I think policy is driving a lot of change as we see governments, certainly the PropTech space or property space, I should say, implementing policy that is forcing companies to do ESG reporting. And that ESG reporting will start to highlight people that are doing really well or not so well. And then that will really shine a light on where investors, where tenants, choose to vote with their dollars or their feet. If I think we'll start to see company or investors not invest in assets that have a poor ESG rating or outcome, and we'll start to see tenants walk away from buildings that maybe don't have a great ESG outcome based on their beliefs and based on their financial outcomes. But again, as investors go to the market, as investors go to VC funds go to investors looking to raise capital, there's certainly the question, and it's becoming a bigger part of the conversation of what is your climate or impact policy? What does your ESG reporting look like that helps you drive that outcome? And if you don't have anything to show, then it's an uphill conversation from there.
Right. Got it. Thank you. Now, so it might not also be impact in terms of climate. I was also thinking that there are some business models which are not SaaS business models. It needs like hardware, right, or manufacturing. They will never be able to compete with software or SaaS in terms of scale, in terms of returns, financial returns, and stuff like that. But the world needs all kinds of problems to be solved, right? So are there, like, if you have to be completely neutral, yes, you'd go to the ones that are scalable, who get hyper scaling and stuff like that. So my question to you was majorly about, do they also keep a portfolio? Do they also have a responsibility saying that, hey, we cannot ignore other important problems because they still solve a big problem. They might not give a high returns financially, but they still need to be solved. And therefore, as a philosophy, we should give part of our funds also to such kind of a business. That is what I was hinting at.
Yeah, I mean, you're totally right to point out the difference between something like SaaS or a software scalable business or a hardware scalable business, and they look very different. There's a very different profile to their sort of potential growth trajectory. At the end of the day, you've got to get resources. You have to have a supply chain. You have to have a manufacturing plant. You have to have all of that calculated and that sort of, I guess, peak capital need and the sort of the capital cost of doing that.
Right.
On the hardware side is much different to coming up with a piece of code that can be distributed globally in a matter of seconds via the internet. That said, the outsized returns come from picking the winners, right? And it also comes down to a question of competition. So while there is there's a lot of competition in the software space. There's a lot of, I guess, companies that will continue to become incredibly valuable. We're seeing obviously the hype around AI at the moment.
NVIDIA.
Yeah, exactly. And so we see that, and of course there's opportunities, but at the end of the day, it's there's going to be incredible opportunities that may have a longer time frame, but in terms will become very valuable businesses that are dealing in the hardware space. And it's really something I think we have to take responsibility for. And is it return on capital at all costs?
Yeah.
You can't have carbon neutral concrete. You can't have green steel. You can't have any of that purely done in code.
Exactly.
And so it does require a different investment mandate. And I think again there'll be funds, and there are funds that are sort of moving to that. I guess, model and are looking to back in some ways that more infrastructure play. And again, LPs will also look to, I guess, diversify, right? They'll allocate to a fund that has a mandate that's purely SaaS. They'll allocate to a fund that has a mandate that might be more infrastructure hardware, right? And they'll, I guess, again, balance their portfolios based on what they believe will happen and their risk tolerance. But there's no way around it. And I think, again, at the end of the day, the climate battle or simply just building a startup in the property space, property inherently is tangible. We can touch it, we can feel it. It has a roof on it. It is going to include some sort of hardware or some sort of, again, to borrow Brendan Wallace's quote, atoms, not bits. And we need to figure out how to unlock that.
Excellent. I love it. Yeah, atoms, not bits. Let's talk about the elephant in the room, right? What do you make out of the current venture climate? You all know what's happening. There is a certain recessionary climate in the entire world, and the kind of valuations that we were looking at with some of these startups have massively gone down. VCs have also run out of a lot of capital to be deployed, so there's not a lot of fresh deployment happening. As a result, the further rounds in many of the companies have been very, very hard, and as a result, many startups are closing down. There is conversations about capital efficiency, about profitability, sustainability, and stuff like that. So with this climate, where do you see these things evolving? Like, are we looking? Is this the end of the tunnel? Is the tunnel going to be even a few more quarters, a year? Do you have a sense of what the environment is? So some thoughts around that.
Yeah, I guess to preface the answer, crystal ball answer, certainly not an economist. But you think about the major influences on the venture capital industry, and therefore the money that they have to then deploy into investments, and therefore the availability of capital to startups. So the big influences on the venture capital industry when dealing with institutional investors and LPs is, again, it's going to come around, there's geopolitical influences again. So wars don't help. So if we can continue to hopefully see the de-escalation of the war in Europe and nothing else really kicks off, and America and China continue to at least not action anything, then again that will that hopefully that stays stable. You think about the LPs in terms of inflation. If we continue to see, I guess, inflation, it looks like it's leveling off at in some respects around the world, and therefore they're able to sort of see what their cost of capital will be, what you can get on interest in the bank versus putting it into an early stage venture business, which is super high risk. And as all of that starts to level out, these LPs will be able to forecast better. And I think that's the thing. It doesn't matter to a certain extent how good or bad it is. It's how stable I think it is therefore allows them to then build a plan around how to navigate that situation better. If it's a super volatile situation, it's hard to make those sort of short to medium term decisions. And therefore it's hard to then allocate based on one theme or one mandate versus another. But where volatility is low, again, even if it's a hugely inflationary period, but volatility is low, then you're going to see people able to sort of action a plan and then start to place capital. So that feeds into the venture capital industry. I think as we discussed earlier, those deployment cycles are getting longer. So $100 million fund is going to deploy that $100 million over 3 years, call it $33 million a year for easy math. Whereas that maybe used to be deployed all in 1 year, right? And then they try to raise again. So that everyone keeps talking about, there's a lot of dry capital available. Yes, but they're going to deploy that in a much slower pace because they want to be more sure about the new investments they make. And they're also going to save that, some of that capital to, again, continue to invest in their winners, the ones that are continue to hit their milestones, continue to hit their growth metrics, and double down on that. So yeah, the crystal ball is not about, we're at the end of the tunnel or where we are in terms of some sort of end or some sort of return to a good period, and however that's defined. It's really how do you understand the current ecosystem right now, and if you are looking to raise, how best to approach that. And so again, if you're really going to have strong metrics to approach a venture capital firm. You're really going to have to show strong traction, strong development in whatever it is that you're doing to convince them that they should put a limited resource into your business. And again, at the end of the day, if you're taking on venture capital, you're making a deal and you're setting yourself up on one trajectory, which is to become a very scalable business in one way or another. I think there's many other, as the venture capitalist on the call, I'd certainly recommend that, startup founders investigate other sources of capital. Venture capital is not the only source of capital. A lot of companies aren't venture backable based on the scalability or based on the growth that they can achieve. And if they understand that and then they can plan for that, you don't have to go down necessarily the venture capital route. And so I think that, again, I know we'll get into it, but considering as a founder where you are and what you want to achieve, I think is the question number one. And then you can discuss, is venture the right way? And if venture is the right way, how do I then look to position myself in the eyes of venture capitalists with the understanding of how the ecosystem works together?
Okay. If not VC, since you mentioned alternative sources, what do you think could be the alternative sources of raising funds for startups?
Well, it depends on the goal, right? I think the most undervalued or underappreciated thing is building a growing business, growing at 10, 20% year on year out of cash flow, and building that for yourself. You're the one and only shareholder. Many people call that a small, medium enterprise or medium business. Where you end up in 20 years, if you continue to execute, is in some ways a similar position, but you've had total control over the outcome yourself. So I think, again, if you're able to build a business, and everyone talks about now, you've got to show profitability, or at least a very quick path to profitability to even entertain venture capitalists who are looking for that. If you can achieve profitability, then I guess you should be able to then grow your business if it's profitable. And I know that there's so many potential nuances to that answer, but
exactly, profitability is also a choice, right? I can make myself profitable by not growing at all, okay, by ensuring and stabilizing my current business, versus not being profitable because I'm actually growing and scaling and increasing the volume of my business. So how do you make that trade-off? And when you are looking or are you saying become profitable during this climate, okay, become sustainable, so that you can show it to your VCs that, hey, I know how to run a sustainable organization, and when things get better, when the climate changes, I would need more capital to grow. Is that how it is?
Yeah, again, the cliche of profitable from day one is just good business practice, right? Again, regardless of the path you want to take. But again, understanding the capital source and therefore the expectation of that capital source on your business is what I think many people misunderstand. If you want to grow your business yourself, build your team, and grow in a sort of local, regional, even sort of national space, you can build a great business and a very valuable business in staying in that location, in staying in that sort of, I guess, or growing in that market, where you will get the financial payoff that you might be looking for. You'll get an impact certainly on a local level that you might be looking for. You'll be able to, again, choose how to engage with your business, be able to work on your business. Whereas as soon as you start to take on other capital sources, regardless of whether it is venture, whether it's debt or whatever it might be, then there's expectations, and it puts other pressures on the business that you may not have to deal with. So if you think of I guess sources of capital, you can think of the debt markets. There's a bit of venture debt, or that venture debt as a capital source is certainly a growing part of the ecosystem. And but they're looking for strong cash flows because they need to sort of de-risk the potential of you paying them back. So again, you need cash flows, and if you can show profitability, then you'll be able to access venture debt. And if you want to access venture capital, again, coming back to what a venture capital business is, it requires highly scalable businesses to invest in, right? So if you want to grow slowly and grow fundamentally through the profitability of your own business, you want to, I guess, not dedicate every waking hour to that business for the next 7 to 10 years, but you want to sort of do it in a much more manageable way. You want to create a lifestyle business that's absolutely fine, and you can create an incredible outcome for yourself. But venture capital is not the source of capital you then go after. If you go after venture capital, you are then, I guess, married to that timeline, and they will be expecting you to hit goals, and there'll be a much bigger expectation on the business and the outcome than if you had stayed away.
So I used to think like you, okay. However, my interaction with VCs only changed my opinion, saying that when there is a VC behind you, you become more disciplined, because if you are the only founder, how do you ensure you're doing enough, you're pushing enough? Okay, so there has to be a demon chasing you, and here the demon, in a healthy way, is a VC who is looking at you and ensuring that you are maximizing the limits of your potential and capturing as much value as possible. So that shift, that aha moment hit me, because I'm also in those some of those conversations. Otherwise, how would I know if I'm pushing my limits or not? So sometimes I feel that having somebody who's chasing and who's actually holding you accountable on metrics, especially if they're putting their own money, that is also a good thing. But it's a choice, right? Do you want a lifestyle business, or do you want a business that is scalable to a large extent? So
yeah, exactly right. And it comes to, intrinsically, it comes down to the person, the founder, CEO, right? How are they motivated? Are they externally motivated, internally motivated? If you're internally motivated, you don't need the demon chasing you. If you're externally motivated, then you may need the demon sort of chasing you and sort of holding you to things. Again, it's 20% of $100 million business, sort of going, or less as an ownership stake on the venture side, or 100% of a $20 million business, and you've been able to achieve that in a much more, I guess, work-life balance way, then again, it's a decision that you're going to make. Yes, it's a question of impact. Your business won't then be in all the markets around the world, as an example. But as a founder looking to start a business, I think you really got to ask yourself again the question: what do I want to achieve out of this business? Who am I? Really, who am I? What is my motivation, and how am I motivated? And then what is the best source of capital based on my goals? Don't start with, I'm going to make a ventures business, and then try and sort of find the solution beforehand. It's, what do I want to achieve? And again, venture businesses, I love working with founders that are driven and motivated, and in some ways, being the devil on our shoulder and pushing us to deliver more value for them, not just the capital. And that's great. And they're really, really, I guess, motivated people in a certain space, and we hold each other to a high standard. But again, creating a lifestyle business is an absolute option for a lot of people. And in a lot of ways, a lot of businesses created today aren't necessarily venture backable, because the scalability aspect and that growth aspect just isn't there for the venture capitalists to see that potential exit and therefore make an investment.
Excellent, cool. That was thought provoking. But it seemed like you mentioned about work-life balance. Is it true that venture-backed founders lose a lot of peace in their life, and it's hard to lead, or you need to be a certain kind of a person to run and lead a venture-backed business? Is that fair to say?
The expectation on a founder that's taken on venture capital is that they will hit certain milestones, and those milestones are always aggressive, whether it's growth, whether it's the validation of technology, whether it's the go-to-market or their cost base, whatever it may be, and all the different stages, seed, A, B, C, and beyond, sort of come with general sort of, I guess, outlines of those expectations. But a venture capitalist isn't giving you money on day one to build your entire business. That's the reason there are stages. The early stage investors will give you some money, right? And it's usually less than $1 million to validate some core aspect of your business, to de-risk your business. And they will want that done in a certain timeline. Again, everyone thinks about this, a 12 to 24-month timeline per funding round. They're looking for you to achieve a goal, build out the platform, get that first enterprise customer, whatever it may be. And then if you hit that milestone, if you achieve that outcome, which again, they're always aggressive, then you come back and you raise another round, and that's where you look to raise more money. And with more money comes the next set of expectations. So it's this constant pressure. Now that doesn't necessarily mean, and I think it's a growing conversation around mental health and work-life balance. What even is that? But I guess the work-life balance, what I'm trying to say there is the founders, burning the candle at both ends. What are the expectations on them? So if you're able to grow a fast-paced business, it's fast-paced, it's hectic, and it's and should be in some ways enjoyable. But that doesn't mean that you have to suffer mentally and physically to achieve that outcome. Yes, it's hard. Yes, it's only for a few people, and only a few people are quite successful at it. But it's something that can be achieved and done in a very sustainable way from a founder perspective. Again, the health and the lifestyle that you lead, while also achieving great results. But again, you've got it. It always comes back to, if you're a founder and you want to grow a big business, but you've got a young family, you've got a partner that's studying, or you can't support yourself for the next 3 years without an income, then trying to grow a ventures business or leaving everything behind to then start it's a big leap to take. I mean, again, we read about a lot of success stories in the paper, but everyone knows that that is such a small percentage of the founders that start. I mean, so PropTech Brisbane, which is an association that was part of founding in Australia, does a market report, and we found that most founders, or also the median age or median industry experience of PropTech founders, was 7 to 10 years. So that means that you're entering the workforce in your young 20s, and usually around that sort of young 30 to mid 30-year-old decides that they've got enough industry experience in whatever it is that they do, whether on the design, the construction, development, product, property management, capital markets and transactions, whatever it is that they're working on. And they're often, and certainly as that sort of generation that's born with a phone in their hand, gets to a certain point, they're like, I think there's a better way. There's a better way to do this. And so they'll then make the choice of, do I continue my career going up the corporate ladder, or do I step away and create a business or a product or a service that then can assist this problem I see every day, I feel every day. And that's usually when most people sort of, make that leap of faith. But that leap of faith, again, if you want to set up a lifestyle business or whatever it may be, can be a much safer bet. But if you want to go down the ventures path, it's in some ways all or nothing for the first few years.
Got it. Thank you. Let's shift gears a bit. You wanted to talk about the branding of the business and the founder, and how do you define yourself? Could you shed some light? What did you want to cover there?
Yeah, I mean, the branding of the business and the founder, right? And really, this is about, at the moment, a lot of new founders will say, how do I raise venture capital today? And if that's the path you've chosen, and you truly believe you have a venture backable business, the nuances of how you present yourself to venture capitalists, right? If you put on your as your one-liner, something that's incredibly old school in terms of a business model or business outcome, you need to pique their interest. At the end of the day, everything is branding and marketing. Your pitch deck is a marketing exercise that delivers information, that starts a conversation that may lead to investment. So if you think about PropTech, unfortunately, as much as you and I, Ravi, want to believe that it is the number one sector, there's certainly always really, hype cycles around certain sectors. We saw it in fintech, we saw it in crypto and Web3. We're seeing it in AI, and then probably climate as well. I think this comes back to a lot of PropTech companies have some sort of, they're working on ESG, on how to report that better, and they have a climate or impact outcome, but they sort of say they're PropTech, or vice versa. I think where we're seeing a lot of the smarter founders sort of brand themselves is, hey, I'm a climate tech. I have a climate outcome. I have an ESG, product or service. I have an impact outcome, and my product or service is deployed on the property industry. It's no secret that the property industry sort of has or emits 40% of CO2 emissions around the world. So it's a huge part of the climate challenge. And again, a lot of companies, whether it's because they're being pushed by policy, whether they're being pushed by their shareholders or their internal employees and workforce, being pushed by their tenants, are looking for solutions to certain things that have that better outcome. And so if I'm a startup founder, I may want to say that, hey, I'm a climate tech that's deployed on property. That might be a branding decision that I make. Again, when you have an investor in mind, read the mandate of their fund. Do I fit into this fund? Should I approach them? Or how do I create a pitch deck that's going to pique their interest because I know what they're looking for? I know the outcomes that they're seeing. So that's a bit of, so I guess, the branding and the tension between climate tech and prop tech that I think I see a lot. Again, I see a lot of prop tech companies or companies that have an outcome based in the property industry, but call themselves climate tech, and that's absolutely fine. But it's clearly a conscious decision. And you think, why do they do that? Well, if you again knock on the door and you say I'm a prop tech, and if someone knocks on the door next to you and says I'm a climate tech, 9 times out of 10, the investor is going to take the meeting with the climate tech company over the prop tech company.
That's the broad perspective. So when you mentioned about brand also is a symbol of authenticity, right? So brand, you cannot fake a brand. Now, obviously you can try faking, but it will not last, right? So does branding also mean for the founder is to make a statement in terms of who you are as an individual? Like, where are you invested in where do you invest your next 5-10 years of your life to a mission? Okay. And do you need to clarify, do you want to be known for something in the industry wherein there could be a VC and the founder fit, right? So is this important also as a founder, that you should clearly let know who you are, what is your mission, and what are you known for?
Absolutely. And it's an efficient question, because what as a founder, you're looking to do is to grow a business. You're not looking to raise capital. That's an element of building a business, but it's not working on the problem or the product or the solution that you have. And so when you're looking to do capital raising, you want to do it in the most efficient and fastest way possible, get that done, get the capital to then go on and continue to grow. A lot of people sort of get caught up in that capital raising is the business, right? And then once we've got it, we'll do something else. And they really focus too much on the capital raising side. So how can you make that process more efficient? As you said, that sort of that founder investor fit really is saying, if you're approaching a company and you're going to spend, and if you think about it and you quantify it, I'm going to send an email, I'm going to create a pitch deck, I'm going to jump on an initial call. If all goes well, there's a second call, there's a round of DD where they're sending me an email every second day asking for some new piece of information. Then we negotiate a term sheet and we sign the term sheet and then we get the sort of the capital, right? That's so many hours for one investor. And obviously it's like a pipeline, right? So you're going to have a lot of first calls, hopefully. But then if half of those first calls and with funds that you quickly realize aren't for you because their mandate doesn't fit the business that you're building, because they look for certain founders, and you know this. So if you're coming in with no industry experience and they say that they only invest in founders that have 10 plus years of industry experience, you can filter those out. So then you can pick a small group of investors to start building a relationship with. And you can start then, as you say, Ravi, I guess, trying to understand them better and look to appeal to what they're looking to achieve through their own fund. Everything's I think, a question of efficiency, right? You want to get to a quick no or a quick yes. It's the ones that are in the middle that just kill time, both from an investor perspective and from a startup perspective. Tell them who you are, tell them what you stand for, tell them what you're going to do, so they can say, yes, let's move to the next step, or no, we're out. It's those long no's that are really detrimental, because it's sucking up so much time from the founder that takes away from actually growing the business. And likewise from an investor, right? If we're continuously teasing out different bits of information. It's really hard for us to get that information because that will help us come to a decision. And if the founders sort of, letting out different pieces of information that really isn't helpful, it's not helping anyone in that process. I mean, investors want to find the diamonds in the rough and move on.
Yeah. So one thing that I've noticed about investors or VCs is many a times they tease the founder. They are non-committal and they never say a clear yes or no. Is this deliberate because they just want to tide time? They want to see, because if it's a no, they are closing the door shut forever. But they do not want to close the door because they still want to be interested. Maybe they're biding their time. But could you shed some light on, because for the founders who are talking to a lot of people, it's so confusing because nobody is giving them the right signals, whether it's a yes or a no. So you keep sending them emails, you keep sending them your progresses, but you do not hear back anything. So how should founders navigate this confusion while they are pursuing some investors?
Yeah, I guess from the investor side, if you think about it, we want to make sure that we have a good reputation in the market, and we want to meet with as many good founders as possible. And venture is a game of accumulation of good relationships, an accumulation of pipeline, an accumulation of I guess, good things that you've done for other people. So whether that's referring them to a different investor, whether that's introducing them to a potential customer or a partner, that's all building up your, I guess, brand value, whether it's as an investor personally and then as part of the firm as a whole. So when a company comes in and it's not a no, because those straight away, but it's not an absolute yes, then there is this game of, I want to let you down, but let you down softly. I want to try and get your feedback, but I don't want to hurt your feelings that if you all of a sudden crush it over the next 12 to 24 months, that I then send you an email. Hey, Ravi, I've seen what you've been doing. Looks amazing. Looks like you're opening up your Series A. Would love to be involved. And you're like, hey, you rejected me last time. Don't want to talk to you. That's the exact email that we're looking, investors are looking to avoid, right? But I think personality-wise, some people prefer direct feedback. For myself as an example, just don't give me the fluff. Just tell me what it is, yes or no, or what I did wrong. I can take it, and I'm not going to take it personal. I'll work on it and we'll move on. Some people, this is again personality-wise, will look to that they do take feedback very personally, and they do, I guess, take especially when you're doing your life's work, your startup and that big risk. It feels so personal that if there's any criticism on that, you take it personally. This is my idea. This is what I've built over the past 5 months. And so if you say something that's negative, I'm taking that personally. And that's, again, another personality type. And so investors need to figure out who the founder is and how to give that feedback without ruining the relationship, because they want to leave the door open. But there's absolutely, I think it's a game of communication. Whether it's communicating between investor and startup and industry, that's probably the role of the association, to try and sit in the middle and help everybody communicate. But if I could say, to you, Ravi, hey, Ravi, love what you're doing. We prefer to invest at companies that have this growth rate, or we don't see this as a big growth market, and that's where you're looking to expand to next. Maybe if you decided to choose this region and not that region, or whatever it may be, and I just tell you straight away. You're about, okay, great, cool. I'll come back to you if our plans change.
Exactly. We would appreciate this. This is every founder will appreciate such kind of clear communication. Without, you don't have to hurt. You don't have to reject. And hey, if a founder does not know how to handle rejection, then it's up to the founder. Okay. Instead, there should be clear rejection. The problem is when there is no rejection, you said something nice in the first email, but post that you have been non-committal. Should I keep sending you updates? Should I keep following up with you? Or am I looking like a jerk if I keep sending you emails after every 2 weeks? Is something that I want. Yeah.
Yeah, no, certainly not the jerk, right? Again, if you haven't been rejected, then the company is in some ways still looking to keep updated and track your business to some point where it gets over a hurdle of whatever it may be, and they're like, okay, we want to look to actively invest or at least dig deeper. So yes, sending me an email every second day, hey, just checking in, did you still want to do this, or what's the next steps, or whatever it may be, is going to at some point become fruitless. But you can put a deadline on it in terms of, hey, look, we're looking to get first responses by this, and then we'll move to the next step with it. Open up the DD room at this date, or whatever it may be.
Got it.
You've got to be able to put us on a timeline that isn't too short, that we don't have the resources to properly assess the deal in that period of time, but not too long that we can sit on our hands. And again, I think the way that most people communicate these days, automated CRMs, keeping that investor on the list and sending them updates, quarterly updates, perfect. And they can choose to re-engage unless they tell you, hey, stop, we're out. Like, don't send me emails anymore. Fine.
Got it.
If there's sort of those non-committals, you've got to sort of back yourself and pick the 2 or 3 investors that are engaging with you and move ahead, and just leave everybody else and put them on that kind of nurturing, nurturing campaign, if you will, that gets updates every quarter, and that's all it is.
Excellent. I'm absolutely loving this conversation, Julian. You bring in so much of knowledge and wisdom from your experience. You mentioned, I was just checking our notes that we built collaboratively. You mentioned something about branding and value with customer in mind. Was it something that you wanted to hint there?
Well, part of our sort of bigger branding conversation, there's 3 major players, I would say, in the ecosystem, right? You've got the startups, you've got the investors, and you have the customer. And if we focus on commercial real estate, the customers are big landlords, big facility management firms, big property management firms, big asset investors or property investors. So between those 3, everyone's got a relationship, right? The startup wants to build a relationship with its customer, but the startup also wants to build a relationship with the investor. The investor wants to know about the good startups, but it also wants to be able to push the startups it invests in into the property companies. And vice versa, the property company wants to know what new technology is coming out that they could potentially implement to make their business better. And so this sort of communication is often there's often a lot of friction, right? Because no one's speaking the same language in terms of, in the property industry, take what capital markets or investment side of things is very formal, it's very detailed. You think about startups, everyone's just slacking each other, and that's about it. All the information you get with a few memes. Investors are communicating in a different way and using terminology and acronyms that no one else understands. So this communication often breaks down, and because it breaks down, therefore people don't really understand what's going on. So when you're talking to investors, we've covered this a lot on this call, you know how to communicate with them. You're talking about your business as an investment opportunity. I'm creating a green steel company. But when I'm talking to an investor, sure, the product, the underlying IP, the underlying asset is important, but this is the investment opportunity. This business is going to strategically grow here. We're going to implement these partners. Our go-to-market and our cost of acquisition is going to go this way because of this, whatever strategy it may be. I'm not talking about green steel and the science behind green steel. That is a fact-checking exercise. Can you produce it? Yes. Okay, how are you going to scale it? How's your business going to grow? If I put money in you today, how are you going to grow the business? That is a very nuanced conversation you're having with an investor. When you're talking to a customer, you're not talking about the business opportunity and the fact that you're going to go into other regions and try and pick up other customers and therefore give them less time, in terms of customer service, which is the way that they will read that. They're really interested in, okay, your product and service, and what's the outcome, what's the value to me? So when you're talking to them, again, these days, certainly in the current economic environment, unless you can move the needle on increasing revenue or decreasing costs, then you're just not going to get a foot in the door. And you want to talk about, okay, and then who is your customer? Is it B2B? Is it B2B2C? And you've got to be able to demonstrate that value and how it's delivered all the way through. So again, the branding is more about the framing of your business and your product or service, depending on the conversation you're having. It's not a one size fits all. And so I guess that was what I was alluding to in the notes, Ravi. But again, I think it's important for founders to hear it, and everybody else as well. have a little bit of empathy for the startup founder, try and understand what they're doing. And if you don't understand something, often in a professional landscape, which VCs and corporates hold themselves to, when they have questions, they'll often hide it because they fear that it means that they're not educated enough in a certain space. Prop tech, emerging technology is just that. It's new, it's innovative. You probably won't understand everything that they're talking about, and so be curious. Don't don't shut them down because you don't understand. Ask the questions, educate yourself, and potentially you'll have a good prop tech to work with moving forward.
Julian, I'm asking a specific question here, which is on how much should you be delaying your initial fundraise? Say you have worked in the industry for 10-15 years, you have accumulated your savings. Should you put in all your savings to build your startup, or should you save your savings and look for fundraise by diluting some part of your company? Is there a guideline? Is there a best practice? Do you have your personal opinion there? Like one thing could be, I'm completely bullish about my idea. I think about it from the deepest gut that this is gonna do well. This is gonna succeed. I believe in it. I'm gonna put everything into this, all my might. So I completely erase my savings and put there, and do not raise any capital in the first 2 years of the business. Is that a good thing to do, or should you not be foolish like that?
No, I wouldn't say foolish, but again, it's risk reward, right? Like you think about you as an investor in your own business, and then how much capital do you want to employ? How much capital do you want to put at risk if your idea doesn't work out? A lot of people with the belief that their business is going to win, and with the risk tolerance that they can put all their capital behind it to try and achieve that outcome. And if you do achieve that outcome, economically, you'll be in a better position because you'll have diluted less. You'll be able to negotiate better when you do come to raise a round. But at the same time, I think, again, it's a personal question based on life stage and life circumstance, right? If you've got, again, a partner that's also being able to support the family financially, and you've had that conversation, if you haven't, have it, because that's often where a lot of founders break down. If there's a founder pairing, it's the partner that can no longer put up with that one founder sort of ignoring the family or ignoring them, and that's where the sort of the cracks start to appear. So have the conversation with your family and with your friends about, this is what I'm looking to do. I'm probably going to need some support. I'm probably going to be moody some days, probably going to be ecstatic others. Again, if you've got a young family, you might be willing to risk less of that that nest egg to chase this idea. But so that's, I guess, a personal question. From an investment perspective, again, what do pre-seed and seed investors, what are they looking for? Of course, they want to see some skin in the game. So if you're a founder and you've got a great plan B with the summer house and a big savings account, and you're just trying to get someone else to fund your idea, and you're not really married to it, then they want to see that you're invested too, you have skin in the game. But then again, from an investment perspective, there'll be different hurdles that different investors are looking for. I mean, if you look at Antler, they try and invest in and spin up their own deal flow, where they sort of invite really seemingly interesting people, very diverse people, to them, and then give them sort of 3 months to come up with an idea, and then they might fund said idea. So that is literally day zero of investing. Day one investors will be looking for some sort of idea. Have you got the industry knowledge? Why use? They're investing in the founder. They're investing in the idea. As you get into seed stage, you've got a beta product. You've maybe got some sort of feedback from a friend, your old colleague that you've given your product back to, and say, hey, try and test this, see if it'll work. Because they felt the pain like you did every day, and so on and so forth. But it is a personal question, Ravi, in terms of how much to put up. There's no golden rule, other than the expectation that you have got skin in the game if you're asking someone else to help finance your idea.
Got it. No, that was a wonderful balanced answer. My last question is, what have been your favorite kind of founders that you have encountered over the years, that you have gone ahead and backed?
Optimistic, I think, would be sort of one word to sort of describe the founders, right? Like optimistic. The glass, there's going to be good days, there's going to be bad days in any job, in any sector, in any life stage. But just you can choose how to approach those certain situations. And when founders come in are optimistic about what they can do, or are trying to come up with an optimistic solution, as opposed to being very negative or very combative all the time. Optimistic is also when you're receiving feedback from customers, when you're receiving feedback from investors, that you've really got to try and detach yourself and how you see yourself from your business, and not try not to take it so personally, and take that feedback as what this one customer may be. Now that one customer or investor may be way off, sure, but it's still the way that you interact in that conversation is going to be somewhat balanced. But yeah, Ravi, I don't know, it's a tough one, to be honest.
Have you been proven wrong by your initial judgment or evaluation of a founder, and then you were caught by surprise by dramatic success of the founder which you had written off?
Of course, and I think anyone that says otherwise is lying, Ravi. I think that at the end of the day, no one has a perfect track record. Even the best investors in the world don't have a perfect track record in terms of the founders or the companies that they're backed. And so, again, the business model of venture capital is the power law. It's understanding that a few of your investments will be the ones that succeed, and you're accepting a failure rate. You're accepting that some of the companies that you bet on won't happen. And also, and the ones that really hurt, as you point out, Ravi, is when you say no to a founder because of the founder at an early stage, or because of the idea, and you're wrong. And they are really successful. And they're the ones that you want to, back to the communication, they're the ones you want to have a good relationship with, have that slow kind of no until such point that you can see those, that they're on a path to success. But of course.
So do founders hold a grudge when somebody rejects them outrightly? And because I thought this is being practical, right? If somebody is reaching you back because now you have proven them, hey, why don't you talk? Do you think even founders reject the investors?
Of course, I think founders absolutely. We're all humans at the end of the day. It doesn't matter what side of the table you're sitting on. We're all humans. We all have our biases, consciously and unconsciously, that we fall into those sort of traps. And I think, again, holding a grudge on someone that you feel has done wrong, is somewhat of a human reaction. But often it comes down to the way that you communicate. If I'm trying to give you honest, fair, and from a good place feedback that your product is terrible, hopefully you can understand how much I care and why I'm telling you.
Got it.
And where if it's a cold email of like, no, business has no chance in scaling, good luck, that maybe delivers the same message of, hey, we're not going to invest, but in a very different way, right? And of course, people will sort of take that differently. But yeah, it's again, it's a tough one when you deal with humans in so many different ways.
Excellent. Well, this brings us to the end of a very, very fascinating conversation with Julian. Julian, I had so many aha moments. Usually when I'm having this conversation, I always figure out which is the best moments so that I can convert them into teaser videos. But we had so many aha moments. I'm now fighting that there'll be competition. Which one will go out for a teaser video? But that goes to show your experience, and you also came across as very thoughtful, warm, somebody who is very grounded, understands people deeply, and has empathy. Is what I really figured from this conversation. Usually, within a conversation, you are able to gauge a lot of things about the other person. So, I completely, thoroughly enjoyed. I was getting bored talking to just founders from PropTech, but talking to thoughtful VCs also is very, very refreshing. So thank you for your time and sharing your wealth of wisdom with us today.
Yeah, no worries, Ravi. And if anyone has any questions on the back of this, whether live today or in the recording, please just feel free to reach out to me. You'll find me on LinkedIn, and I'm more than happy to have a conversation. Again, whether it's from the VC side, startup side, association side, and I'm willing to help any way I can.
Excellent, Julian. Thank you for your time again.
Thanks, Ravi.